Well, hello everybody, and welcome to this week's Middle Class Investor. This is Seth. Sunday, December 3rd. Started off a new month on Friday in the markets, and in general, the week finished up. We can zoom in here and take a look at the week. You can see on the S&P 500, the week finished. It's a pretty strong week actually, all in all. So, but notice where it stopped. I mean, this is kind of an important area that it stopped. We've been talking about the convergence of these channels. You know, you've got this. It's hard to see you zoomed in, but we've got this channel here. It's 1 degree of trend, and the opposite end of it is here. And you've got a larger degree channel here in blue. It's easier. Let me zoom back out. It's easier to see when I zoom out. So when I zoom out, you can see that's kind of an intermediate degree of trend, and then these are kind of minor and minuet degree trends kind of thing. And you can see there's just confluence right in here. Plus, if you go out even further, you can see the green one here. You can see that we've exceeded that one. So you got the green one, the blue one, the purple one, and then there's a little red one in there, and they're all ending right here. And you know, there might be a tendency to go, oh well, you know, that's just coincidence or what have you. And I would caution you on thinking that way. You can see how they all overlap right in here, except for this blue one here. This blue one goes a little higher, and I suppose it's possible that it could go higher. The reason I don't think that's going to happen is because we already had kind of a 1, 2, 3, 4, 5. We had a 5-way move here, but we extended. And usually you don't get too many extensions, especially when it doesn't maybe look like it here, but they're getting smaller and smaller. There's a little 4 or 5 here, so you can see all these little 4. Here's a 4, 5, 4, 5, 4, 5, 4, 5. I mean, there's only so many there. You know, you start getting into the minuscule degrees of trend. Now, the reason the market does that, and we've talked about this before, is because it fractals. The market's fractal. Sorry about that. I got off on the wrong thing here. Let me get back to charts. Because the market fractals, that's why you get that. So for every 4 and 5 here, there's a 1, 2, 3. You know, 1, 2, 3 somewhere in here. So that's what that's all about. Let's look at the Dow though. The Dow's, I'm going to direct you to the Dow here in a minute when I go to another chart from Elliott, drawn by Elliott. And you can see here that we went all the way to over 24,000 here to 24,230. So we set new records, and of course, you know, that's a good thing if you're long, but it is happening at a time when other things are at extremes as well, and we can talk about those here. So just want, you know, I know I've been talking about danger here for the last, I don't know, 3 or 4 weeks. So if you look at this chart this week, you know, basically since here probably, but there's quite a bit of danger here. So I'm not prepared to back off of that just yet. You know, I was reading something the other day. This guy's predicting the market, and it's a pretty smart guy. I know who the guy is. He's predicting the market goes to 40,000 on the Dow, and he cites it's purely a technical deal. He sees a pattern that's similar to some other time in the past, and anyway, that's kind of his thinking. So there's a lot of exuberance, more so than you might think, in the market, and that's fairly typical when you start getting close to, you know, kind of topping action. You start, you know, the cheerleaders just get louder and louder and louder, and so I think there's a lot of reason to be cautious right here. Let's look at let's see. Let's look at what I want to look at first here. Let's just go to the 10-year Treasury. Well, first of all, let's go to the 13-week Treasury, because the Fed's been talking a lot. I think Janet Yellen was on TV the other day, and I think they're really concerned, to be honest with you. I think they're concerned about how are they going to work their way out of this mess that is this QE. You know, they've bought roughly $4.5 trillion worth of government securities and mortgage-backed securities. And, you know, with these interest rates going up, they have to start unwinding that. And that is going to be a challenge for the Federal Reserve. So I think they're starting to get worried about that. You know, I think they thought they had a lot of time to do that, and of course, you know, once they get started, once kind of the writing's on the wall and these interest rates start ticking up, the Fed's gonna have to start unwinding that, and of course, that's gonna exacerbate the problems we have with our financial system. So just be careful, stay out of bonds, stay out of bond funds. Here's the 10-year Treasury right here. I suppose it's possible, you know, we've had this kind of this breakout of this downsloping trend line here, and it's possible that you know, that we get let me get this centered on the page here, that we get, you know, some sort of retest back to the trend line. Maybe not that far though. Maybe more like off of this area right here. I've got that 22.63 area, but this move right here is really going to catch the Fed off guard, and it's going to be pretty rapid. It's not. It's going to look more like this right here, this one over here. So it's going to be very, you know, almost straight up. Whatever the angle is here, you're going to see more of that. So in other words, this next move through here is going to look a lot like this one through here. So except bigger, just a whole degree of trend bigger. So anyway, be on the lookout for that. Be careful about that. I can't stress enough that this is all taken much longer than I thought, which really just means that it's a much larger degree of trend. It's going to last longer. The pain is going to last longer. It's not going to be as fast as the 2008-2009 financial crisis. It's going to take a lot longer. We're going to be in it for a lot longer period of time. So sit back, relax, try to get in. We've talked about some things in here that may be good places to put your money. You know, we've talked about bonds. You know, interest rates going up. You can always look at the TBT. Is it TBT or TLT? The TBT doesn't look too good actually. Yeah, so it's the TLT, I think. That doesn't make sense though either. It must be the TBT. Oh, that looks really bad right there. Yeah, this low back here in 2016 coincides with the low in the bond market, the low in yields, and then this is your wave 2 pullback. And so, you know, certainly, you know, a break above this area here, which is, what is that? That's about 37 on the TBT. You know, you start getting a break above this area right here, then I think you could safely say this downtrend's over. I mean, we're already, you know, the downsloping line has already been broken here, and we're getting some sort of consolidation here. I mean, I think what I would look for is probably something like this, and then, you know, look for a couple of these, and then somewhere in here it's probably safe to maybe go long the TBT. And if you know anything about calls, you can sell some calls along the way, because this is going to be a very slow moving. I mean, it's going to move fast relative to a lot of things, but the TBT is an ETF that moves pretty slow. So, you know, so you might say, well, you know, how far could it go? Well, you know, one of the tools I use is like is Fibonacci. So you could take like a Fibonacci retracement from here up, and you could, you know, kind of set yourself a target. And of course, we got to zoom out to look at that target. Let's zoom out a little bit. But you know, I would look. Gosh, I zoom back in. I guess what I see as an important pivot area is this swing right here. So you know, look for a move into this 262 area, which is $65. So $34 to $65 is a pretty good return. You know, when the whole market's going down. So, and then I would say, you know, before you get any retracement, any significant retracement. So in other words, it can go. What this might look like, just to try to give you a sense of how the market moves. I mean, it's not going to go straight. I'm going to draw a straight line, but let's say it goes to here, roughly, somewhere around in here, pulls back some, and then finishes and goes to there, okay? And then here you should see some sort of retracement, maybe back down into this 50 area. Maybe not that far, maybe only down into the 60 area. So, but this move right here would be the one you would want to catch. You would try to catch this move here to, you know, the 65 area, and then, you know, take your profits and let it pull back, and then maybe look to re-enter, and then make the next move up into here, and then take some profits, and so on and so forth. Okay. Hopefully that's clear to everybody. The other thing you can do is there's short. If you go to Google and you type in short ETFs, short ETF, you can go to these pro shares. The 4 best ETFs to short the market. You could go here to Investopedia, and they talk about, you know, what the here's an SH, an SDS, the CHAD. What I would do before I bought any of those is I would look at. So let me just show you here. Let me put the volume in here, and let's look at what was it, SH, I guess, for short. So I would just look at the volume here. Yeah, see, it's almost 15 million shares a day, 10 million shares a day. There's plenty of volume in that. Let's see what the SDS has. The SDS is even higher. It looks like its average is around 22 million, 23 million. So what you want to do is, if you are buying ETFs of any kind, you just want to make sure there's plenty of volume in there, because that helps you, you know, get in and out of it. If you decide you don't want to be in it and you want to get out of it, you need to be able to do that. And the volume, there needs to be plenty of action in it for you to be able to do that. So, all right, let's look at some of these other countries. Germany, been looking at those. They really haven't changed since last week, as you can see here. Germany is still in this resistance area. Looks like it's chopping. I mean, it could be it, right? You've got a high, came down and made a low, ran up and made a lower high. So it could be that we're going to get a pretty good pullback here, maybe into this area. And I would say once that happened, let's say you get a pullback into this area like this, you would get some sort of correction back up. If it does this, if the next move is this, then this trend is probably done. So Japan, you know, Japan's just kind of destroying its currency, so it could be that Japan's going to keep going here. We should have to keep an eye on it. The United Kingdom is locked pretty heavily into this channel, and I would say, you know, what you're looking for there is for this to resolve itself to the downside. Certainly, you're going to at least get some sort of downside move into the other side of the channel, even if it's going to continue to go back up. But this looks corrective, so ultimately it looks like the big move for the United Kingdom is down. So these markets are all kind of, except maybe for Japan, they're all kind of lined up to move lower. I'm going to show you some pretty key charts from Elliott Wave Theorist this past week, which I think are really important, and I I can't do any better, so I might as well just show you theirs. Before I do that, though, let's move over to the regular charts and just look at gold and some of these others. We talked about these different scenarios last time. Looks like maybe we might be on this one where we're going to pull back into this area and then maybe run up into here. We'll just have to see. Like I said last time, the length of time this went down versus the length of time this has gone up are not equal. So to me, there's got to be some more action in this move up, and it could very well be that it comes down and then kind of moves back up into here and then comes down. So then this time frame looks more like this time frame. So price and time both are important, and you have to kind of take that into consideration if you're planning a trade or planning on what kind of position you want to be in. Let's look at crude light. So crude has been moving higher. Now the dollar, and we'll look at the euro in a second, but the dollar is kind of at a critical point where it looks like it could maybe start rallying again. And it may be that crude gets up into this area around 60. Maybe it doesn't get that far. Maybe I've drawn this box a little too high. This box is drawn right off of this pivot here. So it could be that we see oil maybe spike up into this area and then start selling off as the dollar starts taking back off to the upside. Let's look at the euro and you'll see what I'm saying. So here's the euro. So if I get a scale over here, yeah. So you can see here we're right below 1.2. We're at this 1.18 area, and the euro looks like it wants to roll over and go lower. I mean, this move down and this rapid move back up. Now it could be that it goes a little higher, maybe into this area, and then rolls over. But the euro, if you look at the COT data, the commitment of traders data, there's a lot of imbalance to the upside on the euro and to the downside on the dollar, and that usually creates the opposite kind of move in the market. So you just want to be aware of that. That can affect gold and other things that are dollar denominated, oil and gold primarily that we talk about here. So just be aware of that. All right, let's switch back to the market. I'm going to show you the Elliott charts. Let's go to this one. So this is the down to the wire kind of announcement. He puts out these interim bulletins when things when some big milestone has happened. So this is the Dow Jones transportation average. Let me make sure I can get you in the screen here, and you can see here he's counted out what's called an ending diagonal pattern, which is usually trend terminal. So it usually happens in a final fifth wave, and it usually marks the end of a trend. So we should know pretty quickly whether this is actually an ending diagonal. Just because it looks like one right now doesn't necessarily mean it's one. These are just names that they give these things, but it has the characteristics of an ending diagonal, and the way those work is that they quickly resolve back to the beginning. The beginning in this case is right here, and then theoretically you get some sort of retracement, and then the next wave down would be a 3 and much larger. So what's cool here on this is you can kind of see some of this stuff here. So I've been talking about the bond market and what the next move is, and we showed that that low in July of 2016, and then first rally up, and then you've got this correction. But now these periods of time are shorter, but this kind of shows you how the wave pattern tends to unfold. So you have this big move up, a pullback, and then the next move up is really big relative to the first one. You can see how much larger the 3 is relative to the 1. And you can see here this 1, so this was the first 1, and this was the first 2. But then this 1, 2, 3, this is a lesser degree of trend. So this is a 3 inside of this larger 1, 2, 3, 4, 5. Does that make sense? So, and then you can see how the 5 Whoops. Oh, sorry about that. You can see how the 5 has resolved itself here, where it's slowing down, and usually this gets retraced at least to here, and then sometimes the whole thing gets retraced. So that's the Dow Jones Industrial. That's the transportation average. Now this is the this chart here is of the Dow Jones Industrial Average, and what's important to see here is this area here. We talked about these different trend lines and how they're, so he's got like an intermediate trend line here, that's the little one, and then he's got the larger, what he calls primary degree trend line, and both lines have been pierced on the log scale, and you can see that here. He zooms in to show it here. Here's the intermediate line, here's the longer term primary line. Both of these lines have been pierced, and the market, when the market comes back down through these lines, that should be the end. So that's how close we are. If the market were to pull, let's do a little drawing here. So right now the market's closed. The close was right here. You can kind of see that. So what we're looking for is if the market pulls back down here and closes below both of these lines, then this trend is likely complete, and we should start seeing pretty rapid moves, increase in volatility, all kinds of things that start showing us that's kind of the end. Okay, now this is the S&P, and the S&P. So what's unusual about this, if you want to pick out something unusual, is the Dow has made these moves on a log scale, and here, I'm sorry, I'm trying to get this in just the right spot for you. And this is on an arithmetic. So the difference between a log and arithmetic has to do with the equidistant, as the market goes up and up and up, 1,000-point move down is not as big as it was, let's say, 30 years ago. So in order to get the same form and look, you start looking at things on a log scale. But the S&P has done essentially the same thing the Dow did, but on an arithmetic scale. So that's the difference between the two. And again, you can see here, here's the zoomed in version. You can see here's the long-term trend, here's the intermediate trend, and in this case, the market has already come down below both of these trend lines. Now it may not have come down low enough. It may kind of go back up a little bit and then come down again, but it's just interesting that the market tends to do this. I mean, these things tend to work, so you really shouldn't ignore them, and if you do, you have to kind of ignore them at your own peril. I'm trying to think if there's anything we've left out. We talked about the euro, British pound. I think was selling off a little bit. Looks like it wants to sell off a little further. This is another one that I think is likely probably to go up, but it may go down at first as the dollar rallies. So as the dollar rallies, you could see this pull back all the way back into here. But this could be the first move off the bottom, in which case we could be looking for a wave 3 like this. So, we were talking about things you could invest in, while the market's blowing up or whatever. We also looked at the FXB, which is the British pound. And you can see we're still above the trend line. But on the FXB, I would look for this to pull back to the trend line, and it could violate it a little bit. But once you see it stop going down and it starts making a couple of higher highs, that would be a good place to probably put some money. These are things I'm going to be looking at as well. So, and I'm going to be short the market. So I'm going to short the market, and I'm going to be looking for things that I can just put some money in and just kind of hold it for a while. Now, as volatility upticks or ticks up, in fact, maybe we should look at volatility. Let me just type it in. I can never find. It's because it doesn't start with a V down here in my list, so I can never find it. So as volatility ticks up, one of the things we might talk about doing in here is selling covered calls. So right now calls aren't worth very much because the volatility is so low. But once the volatility starts trading in this areas up here, calls are going to be worth quite a bit. So let's say you're in the FXB, or let's say you're in the TBT. Okay, so let's zoom in a little bit here. So so the way the market moves, and we've talked about this before, but it moves, it moves up, right? And then it sells off, right? And then starts moving back up like so, right? It's kind of how it does it. So what happens is when it moves up, you're in the stock, okay? You own the stock. But when it starts to curl over, when this starts to curl down, and how do you do that? How do you know? Well, one of the things you can do is you can put in a, oops, that's the wrong thing. You can put in like a trend line, okay? A channel. Okay, and as it breaks the channel, you say, okay, I'm going to sell a call option up here out of the money. Okay, so let's just look at a real quick example. Let's say this starts to go up. Let's say this goes up to, well, let's pretend that right now it's starting to roll over, okay? Because that's really the only way I'm able to show you the pricing that makes sense. But if I go to the trade tab, okay, and I put in TBT, these are my calls. So remember, calls are on the left, puts are on the right. So we're going to focus on the left-hand side, and we'll reduce this to about 10 strikes. And usually when you're selling calls, you just want to sell 30 to 40 days out. So we would look at this, and then as the market's rolling over, we would sell the at the money call. This is at the money. Okay, so you sell single, and let's say I had only 100 shares of TBT. So that means I'm going to sell one contract. One contract controls 100 shares. Okay, so when I hit confirm and send, so first of all, the reason it's saying max profit is infinite, and then it says max loss $62, not including dividend risk. First of all, anytime you have what I'm talking about is a covered call. So covered call, the max profit, it was not infinite on a covered call, because if the market turned around and hit the strike at expiration, you would get called away from the stock. So these are terms that maybe you need to kind of familiarize yourself with later on. But essentially what you're doing is you're selling somebody the right to buy your stock at this strike price. Okay, so let's back up and look at this again. So what is the strike price? Strike price in this case is 35, and so I'm selling one contract, which is 100 shares of TBT at 35, and I can be called away from the stock. That's what the call means. In other words, I own the stock. I own 100 shares, but I'm selling somebody the right to buy those 100 shares from me at $35. Now, let's go back to the chart and talk about when would that happen. What are the situations? And maybe to explain it, let's look at this right here. So I'm changing the strike, okay, because I got to show you a place where it rolls over. So this might confuse you a little bit, hopefully not. But so as the market's coming up, it's coming up, and it starts to roll over like this. In this case, I would sell a 42 strike right here. Okay. Now, what does that mean? That means in the next 47 days, now if the stock does just what it's doing here, if it rolls all the way down here, somewhere in here, I can buy back my option. So I sold it for 62 cents. Maybe I can buy it back for, 8 cents or something, 0 or 5 cents. Okay, just to get the risk off the table, because here's what happens. It's worth 5 cents here. So up here, it was worth 62 cents. Okay. But as the value of your stock is going down, okay, but the value of your option is going down too, but you sold it. So you want the value of your option to go down. So you sold it for 62, and then let's say the market starts to turn back up here and you buy it back for a nickel. That means you made, what is that, 57 cents, right? You made 57 cents times 100, or $57. Now, let's suppose the market didn't come all the way down here. Let's suppose it came down 1 or 2 days and then shot right back up, okay? And you didn't do anything. Well, that means at this price right here, at this point right here where this line is, whoever you sold that option to has the right to take the stock from you at that price, even though the stock's trading up here now. So the stock's trading up here, but you have a contract to sell the stock to somebody at this price. So why would you do that? Well, the only reason you would do that is because the market moves up and it moves down. So it tends to move up until, you know, buy orders run out, and then it starts to sell off, and then it starts to run up again. Okay? So the risk in a covered call strategy is not in the option. It's not in the option. It's in the stock. Okay? You own 100 shares. In this case, 100 times 42, 72 is $4,272. So obviously, as this stock starts to roll down, your $4,272 becomes $3,988, so on and so forth. So the reason you want to sell calls is because over time, if I make $62 every time this thing rolls over, but let's say over time the stock goes up 10%, but for 15 different times I sold $62, then my overall return is not just 10%, it's more like 30% on that stock. Okay, so it's just a way to increase your return on stocks you already own. Okay, we can talk more about that later, especially if somebody wants to comment and say, yeah, I want to know more about that. Then just put a note in the comment section and let me know that you want to know more about that. If you don't care anything about that, if nobody cares about that, then I'll quit talking about it. But it's a good, if you own stocks, it's a good way to make money on the stock, you know, because options are kind of an income, they can be an income vehicle. So where stock is more about capital appreciation and dividends and things like that. So hopefully that didn't confuse everybody, but maybe we can talk about it again on another time and explain it in some more detail. All right. I'm trying to think if there's anything else I wanted to point out. I would just, next week's going to be an interesting week. One thing to remember is that the market typically doesn't top on bad news. Okay, so if you think about it, last week we got there was some news that came out. First of all, I don't think the news. Let me just say something real quick about the news. I don't think the news really matters from a bigger trend standpoint. It can cause, you know, it can wreak havoc intraday. Okay, so the other day, Friday, you know, you had this news come out that Flynn was going to, you know, he's pleading guilty, and presumption is he's going to rat on Trump and all this, and the market sold off. Okay. Notice how it went right back up. So, you know, the market rarely tops on bad news. I guess we could say that was bad news. But what kind of news do we have coming out? The market usually tops on good news. So next week you could have a situation, and I don't know. Okay, I'm just speculating. I just think next week's going to be interesting because there's some stuff happening next week. But you could have a situation where the market kind of rallies up on this. These are daily bars, by the way. So this would be like Monday, Tuesday. So you could have a situation where the market rallies on some news about the tax cuts. So maybe the tax cuts go through. You get a situation like this, and then boom, you get something like this. Okay, so this could be Monday, Tuesday, Wednesday, Thursday, and then, you know, maybe Friday's kind of a nothing day or something. But this could be kind of the beginning of the end, so to speak, of this bull market. So just kind of keep an eye out. Next week I think it's going to be telling. You know, usually you don't get just a massive like that because there's still people that believe in the rally, so it takes some time, but it could be that that next week we exceed some shorter term trend line and then immediately fall down back below it and start selling off. So look for next week. Pay attention to this news. Could mark the top. I think that would be very interesting if it did. I don't know what that means. I mean, who knows what that means, right? Does that mean somehow the stock market believes that the tax cuts aren't really going to do anything, or it's the wrong kind of tax cut? I don't know. I don't know what it means. I just know that most people think it's good news. So if the market rallies and then tops and rolls over, that technically would be on good news. So just look for that to happen, or look to see if it happens. It may not happen. Maybe nothing happens with the tax cuts next week. But I think those kinds of things are interesting because it usually is just the opposite of what everybody thinks, right? And so that's kind of the way the market is. The market, tries to fool the most amount of people the most amount of time. So it'll just be interesting to see how that pans out next week. All right, everybody, that is about it for this week. I really appreciate you coming in. Hopefully you can start forwarding the links to your friends and family. I think it's going to be really important. Maybe you're sitting out there, maybe you want a little evidence first, and that's fine. I understand the skepticism. I'm a pretty skeptical person myself. So if you have any comments or anything, just drop me a line here in the comments section, and we'll try to answer them here on next week. All right, everybody, take care and have a great week. Bye-bye.